All right, welcome to the greatest panel of the day, self-declared. So we're going to talk about tokenization today, and I just want to set the table in a very simple manner. So it's really important to define these things clearly, so then you can have a clear conversation. So when you think about tokenization, think of the property rights of any asset moving to digital form on a blockchain, and the reason why everything's moving in that direction is because the user experience is just going to be better. It allows you to do programmability of your money and other things. 5 years ago, we were looking at a tokenization market that was roughly $25 billion. Today, it's sitting at around $325 billion, and most of that is stablecoin. So what we're going to talk about on the panel is where do we go from here? It's a very exciting time, but where do we go from here? So I appreciate the panelists for being here. You all look fantastic. Thank you for joining the best panel of the day. We're going to start off on the institutional side, and I'm going to hand this one to Brett Teschball. So everything on institutional that you're hearing and seeing in the context of digital assets kind of starts and ends with Brett at Coinbase, which is very interesting. So it's great to have him here. And look, Brett, we've gone from an environment where there was not regulatory friction, there was regulatory blockage in the United States, to a world now where the SEC chair is saying, hey, in 2 years, everything's going to be on chain. So we're now in a regulatory sprint as opposed to a blockage. How are you keeping up? What are you seeing in the context of that regulatory sprint? Is it global? Is it just the US? I'd love to hear your thoughts on this.
Sure. Welcome, everyone. And so pleased that we have some people in here while Brian Armstrong, my founder, is speaking out there. So this is super cool. I have to take a picture. It's never happened before. So let's see. As you said, it was frigid, frozen, terrible in the US. We had a new administration, everyone knows that, but the Genius Act passed. When the Genius Act passed, that allowed stablecoins to enter the mainstream of America. And so that singular moment is the enormous catalyst. Although it was specific to stablecoins, what now happened is that every bank has to think about their deposits. Every financial institution has to think about how financial commerce happens. You have to think about how collateral management happens. And so we've had an absolute deluge of firms that have now called back the digital team, the crypto team, go find the crypto guy or girl and get them back in here, and what's our plan? And so that happened to coincide with a moment where we're doing our Amazon to AWS pivot, where all the things we built in our prime broker, we're now offering out to the world. And so we've got crypto as a service. Crypto as a service is custody, wallets, brokerage, financing, staking, all as a service. And so I'll end with saying, like, as a sign of the times, I'm here to make 4 major announcements this week. Yesterday, we announced PNC Bank, which is the 6th largest bank in the U.S., has opted in with the other 264 clients we have, for crypto as a service to empower their clients to be able to buy and sell Bitcoin on their PNC app. We also announced today Standard Chartered. So Standard Chartered, huge global bank, presence here, presence everywhere. They have their own custody and Zodiac capabilities, but yet they're partnering with Coinbase to be able to participate in what's happening. There's 2 more announcements, which I'm not allowed to front run, but they're going to be really important. So pay attention the next 2 days. And it's about the transformation of capital markets. So some tokenization, which we'll talk about, is coming our way.
Amazing. I'm going to turn it to Oya next. So if you don't know Ondo Finance, BlackRock is a household name. If you think of the people who are really doing a ton of very interesting work in the space, Ondo Finance is definitely one of them for people who are intimately familiar with it. Oya, you've seen some really incredible growth opportunities in the context of Ondo with your short-term treasury. So think of stablecoin as kind of your payment layer of the crypto infrastructure. It's being talked about a lot. Now you move into the securities infrastructure, and you guys have done a really elegant job of bringing short-term treasury securities to the market in token form. AUM of some of the products up 3 times this year. Talk about the growth you're seeing, the frictions you're seeing, where you see that, initial conditions. Why did you guys start with treasuries? Why not other things? I'd love to hear about it.
So we started with treasuries because our whole premise was to bring liquid financial instruments on chain. And stable coins have obviously had huge success, but they were missing a couple key ingredients. One was yield, which when treasuries are paying 5+% became kind of an elephant in the room. And the second was around transparency of holdings and third-party auditing. So we brought those two things in to a stable coin, and it was kind of a no-brainer for investors to make that shift if they had any idle stable coins sitting to tokenized treasuries that we offer. In terms of OUSG, which is our qualified investor product, which offers exposure to short-term US treasuries, that, as you said, has tripled in TVL this year, and that shows that there's institutional investors coming on chain looking for cash equivalents in a safe way on chain.
Awesome. Mark, so we've got stablecoin, we move out to short-term treasuries. Now you have broader debt markets. When I think of broader debt markets, I mean, we like to think of equities a lot, but when you think of what drives an economy, it's credit. So now you're thinking on the Camino side, you're thinking of it a little more broadly in the context of bringing broader debt markets on chain. What do you think in terms of programmability of debt and money as a general matter? What do you think TradFi is missing? Where do you think the opportunities are? How does Camino fit into that equation? Love to hear your thoughts.
Sure. Yeah, I mean, with Camino, we've built Solana's largest credit marketplace. So permissionless blockchain, permissionless access, and then Camino provides a marketplace for borrowers to meet lenders. And yeah, we really see that's evolved in the last couple of years from crypto native assets to now tokenization of real world assets, including tokenized debt. And the accessibility that a public blockchain brings and a DeFi protocol brings is unmatched, basically. So really happy with the progress. We've worked hand in hand with stablecoin issuers, but then more recently tokenization partners who are bringing these freely accessible tokens to Solana and to Camino. For example, actually just last week, Figure, who've got a multi-billion home equity line of credit business, they've brought tokenized HELOCs, as they're called, to Solana, and we've partnered with them to bring them as collateral on Camino. And this is a 8% yielding asset. The DeFi participants already in the last week in the tens of millions are bringing these HELOCs to Camino, collateralizing them, taking loans, and you've got stablecoin holders taking the other side and underwriting credit against this collateral.
So who are the providers of capital in that case?
Yeah, absolutely.
Oh, no, who are they? Who are the providers of capital in that case?
So on the stablecoin side, anybody who wants yield on dollars, and the beauty of DeFi, we've got retail users in the hundreds of dollars, and we've got large scale credit funds who are supplying tens, sometimes 50, 60 million dollars, and they're underwriting debt against these kind of high quality collaterals.
Got it.
Yeah.
Awesome.
Or some of the use case I see on that for the most in the big institutional space, so beyond the retail side, are private equity companies that actually want to fund their portfolio companies, but they don't want to go through a many-month process and all the fees and friction that are associated. So on the platform that you built, we've actually seen issuers and investors come together and be able to launch an auction process, a clearing of price, and then private equity company funds portfolio company. It's magic. It's awesome.
Genius.
Genius, one would say.
Patrick, welcome. So the funny anecdote with Patrick, I live in Abu Dhabi, I live around the corner, and I think Patrick has spent more time in Abu Dhabi than I have in the past year. It's really amazing. And he's Michigan native, so he paints the town blue for those of you who like Michigan football. But thanks for being here. Not surprised you're here, but thanks for being here. My heart is kind of in financial plumbing. I think with the wrong financial plumbing, the kind of whatever you're building on top gets very weak. You're doing just really incredible things on the plumbing side. Data. So when you think about tokenization, I think it's great to bring things on chain because you can do all these things with it. But if you don't bring the layers on chain beneath it, then you're adding new bottlenecks. Now you're solving that problem, and you were super early to solving that problem. The argument that I hear a lot from people is to say, okay, great, you want to do all these interesting things at the roots to bring on chain. Why isn't data on chain just like a PDF file? What's the value proposition? And I think that it's an unfortunate criticism, but I think it's just an easy one to negate and as you describe your business and how you're thinking about it.
Yeah, if you have debt against an underlying physical real asset, the value of that debt only corresponds directly to the value of the underlying collateral. And the ability to surveil your collateral real time on a daily basis and reprice your collateral is a reality today. And that was not a reality before. And we have large institutional clients, banks, sovereign wealth funds that are beginning to price their data-rich, low-frequency trading assets on go from an annual mark to a quarterly mark to a monthly mark to a weekly and then to a daily. And right now, I'll give an example. We have a top 20 bank. Every loan that they originate in the United States lives natively on our platform. And instead of one mark a year that they get a third party, and then they get three desktop analysis for their collateral posting that they're funding via derivatives, total return swaps, they're now getting 12 third-party marks, and they can see and use an AVM, intra third-party mark, and that's coming not out as a PDF that a first-year Cornell grad has to 10-finger automate the data in, but it's literally real-time pushing in. In addition, we are using agents to surveil those assets real-time, and when we surveil that asset, we're surveilling the native systems of the asset itself, and the unstructured data, which is the context, so that you can use smart, intelligent functions that you're renting against those with full context, so not structured data, which is the dumbest form of data.
Okay, so if I think of this right, you're getting clear, fair marks on collateral.
Yes.
And that allows you to then do other interesting things with your excess capital. Is that more efficient utilization of capital? Is that fair?
It's price discovery, right? And what does price discovery do? It explodes the markets in 100 different ways, right? So what's the NAV of the collateral? Then I can run the waterfall, the carry calculation, the expense allocation, reprice the capital stack, and retrade it. Today, sovereigns buy and hold, and they don't really think about sell. We give them the ability with daily marks on their whole portfolio, the ability to buy, hold, sell, or add to the position. And this is price discovery. For that, you need venues, and for that, you need structured product. But it begins with data that allows them to understand the portfolio itself.
So what are you disrupting in this process?
Private markets. The entire secondaries market is exploding. The ability to provide price discovery, how you post collateral, moving level 3 assets to level 2, so the accounting treatment on those assets changes. But in addition, this function allows people to understand the performance, so data operations, right? So this is data operations at scale in an agentic world where you're connecting agents up to process your data and deliver them to any form of automation you want. That form of automation may be a smart contract. That form of automation may be an agent. It may be another agent in a counterparty. And that counterparty is going to need to know proof of origin of that data, proof of process of that data, and proof of state of that data.
Full traceability.
Full traceability of all data beginning to end. Let me give a really cool example. The new RTE requirements for the use of sale of semiconductor chips to the Middle East, those requirements came out literally 2 weeks ago. We beta tested a compliance agent for that is anchoring proof of origin, process, and state of the data being processed through a chip so that those Arab states can prove compliance with the new legislation so they can take delivery of the newest NVIDIA chips. And that's happening with zero knowledge proofs on chain on multiple chains,
awesome.
Right?
That's plumbing. Cool. I like it. I'm going to move to a theme of yield. Just to identify as assets come on chain, the simplest form is to generate yield. I'm going to start with Oya. Okay, does the best user experience win? I mean, this is the one thing that when I think of the internet, everybody says, well, geez, we're at like this stage of the internet. I'm like, okay, great. And I think back to '94 when the internet was slapping me in the face as a young buck at the Bank of Canada, and I think of what would I have invested in? probably not the use cases. I would have probably have gone to like infrastructure. I had no money, so I wasn't investing. But if I had, I would have thought of the infrastructure, not the user experience. And it kind of stuck with me. So is it that the best user experience wins and the best user experience then migrates to higher yielding product? How do you think about that?
I don't think the best user interface wins, but I would preface this by saying I'm probably one of the more conservative people in digital assets. I think liquidity and regulatory compliance and visibility wins over user experience, at least to the investor profile that we're targeting.
And Mark, I mean, as investors come on chain, you're giving them a whole swath of things to contemplate. You're making a big bet on Solana, obviously. This is a big part of this is your core. How focused are investors on the underlying chain versus what you're able to deliver through that chain?
Yeah, I think we're moving now into an era where the chain is more an infra layer that just works and is the global marketplace. So we've built on Solana because of this thesis that it scales, it's fast, it's cheap, and it can be a global ledger for on-chain finance. And we're moving from like the geeky phase of building on-chain to now the building UX, building good protocols, and really like the engine room of yield. So if we take, for example, Coinbase, similar exchanges, they are often now the front end to yield on chain and can provide easy to use products, which then uses the on-chain primitives like Camino, which has the borrowers, which has the yield generation activities from specialists to kind of power this economy. So yeah, it's now absolutely a new era. Less chain maxis. You need to care less about the infra layer, but more about the.
You just want to make sure it works. Safe, secure,
absolutely,
and it works. Okay,
absolutely, yeah.
Got it. Brett, if I had a song I could play right now, it would be "It's All About the Bass." That's So the base coin. Look, the base chain has been just a remarkable success. The amount of building that it's generating is super interesting. Obviously, some of the things that you described earlier are intricately connected to Base. Base is an EVM platform. It's building on Ethereum. Do you see fragmentation of chains problematic or risk? How do you think about Coinbase's choice with Base in this case?
I appreciate the tee up to Base, but I'm going to give a shout out to Solana. So I kind of want to prove to the audience that I'm the markets guy at Coinbase. And so, yes, we have an affinity for Base, and yes, we have a commercial arrangement with Circle. But as the markets guy at Coinbase, I'm a platform guy. So I'm a free marketplace guy. And so what I'd like to do is partner with everyone on the stage here, including Solana, who, by the way, is doing a fantastic job of scaling use cases on chain. And I want to get to the point where, Coinbase is a single entry point into the digital ecosystem. I hope we curate experiences to the extent institutions want us to do that. But it's super important to have a multi-chain world. Now, specific to Base, yeah, I'd love to see developer activity on something that Coinbase incubated and progressively over time will become more decentralized. But what I like about what's going on today is that sometimes the crypto kids in this world. I'm not a crypto kid. I've got gray hair. There's not that many people that do, but I've been through a few cycles. And so when I first joined Coinbase, in the lending space, there are a lot of people and engineers that just sort of went, oh, this is like free money and free yield, and you can get 8%, 9%, 12%, look at that. We can do recursive yield. And then it all blew up. And so what I like about what's going on today is that we have progressively more people with real experience in understanding risk, understanding the importance of data, the importance of selecting the right chain, the importance of customer experience, putting that all together and actually generating yield and new instruments in what I think is generally a more responsible way. and constructing things that, once you give them a shake or the market moves or you have a price dislocation, they don't fall apart. So anyway, we're in a good phase there now. I love the development on Base, but I actually really also embrace the development on Solana and other chains.
Very good. Very good. Patrick, similar line of thought. So as more and more investors seek yield and things like that on chain, what do you think investors need from NVIDIA and the services you're offering? Do they just need legal clarity, data clarity? What is it that you're hearing from the investor base to say this is what I need from NVIDIA in the background to just be confident that I can engage on chain?
So I think pre and post trade servicing of the asset in a bulletproof manner, where they can understand data operations at scale, connecting those data elements without leaking their data, right? And that is ZK proofs at scale being used with delivery, with permissioned access, and then integrating with forms of automation where the data retention obligations of the participants are respected and met. And so as the big institutions do this, if they want to buy a digitally native asset like Bitcoin, that's easier. But if you're going to have mezz or senior debt trading and you want real access to the underlying asset performance, how are you meeting your data obligations around retention and you're not leaking that data all over? So as long as we can meet those data retention obligations and deliver that in this agentic form to the smart contract that's going to inform the digital instrument so it can be traded, they're all in. Because everybody agrees that the middle office for alts is going to be transformed. It can be transformed, and it's not going to save 3 basis points. It's not going to save 7 basis points. It's going to save 60, right? And it is going to matter. But then the other thing is that the discount for lack of marketable information on private market assets, when we have an agent that can surveil that, you're not going to take a 20% haircut when you sell your secondaries to Collar Capital, or you're not going to give 600 basis points to Evercore to sell that secondary. That's literally going to be denominated in a couple hundred basis points, maybe 1 to 2. And when you cut out that middle office drag, it creates huge opportunities.
15 lines of code. That's all. We're going to replace middle offices with 15 lines of code. So Brett commented on having gray hair. I'll show my vintage. I have paper. Everyone else is reading from that. I brought paper for my guidance. So it's. I want to move to the risk side of things. It's a common question, and we're gonna pick it up. We have the last couple of minutes left, so we got to be quick on this one. But if you think about risk scenarios, people like to ask the question of what keeps you up at night. And this is a group that sleeps, I promise you. They sleep well. So it's more of what's waking you up at 2 a.m. where you're like, oh no. So maybe just go across the group. Start with Oya. What's waking you up at 2:30 in the morning?
Yeah. Well, I started my career structuring CDOs at Lehman Brothers, so I'm not easily scared off. But I think in our sector, it's vulnerability to hacks is probably what makes me up if my kids don't.
Mark?
Yeah, so I mean, Camino's been battle tested now for more than 2 years. For us, yeah, it's absolutely risk is number one priority. That covers both market risk, because we're involved in configuring market parameters. We need to understand asset volatility and the like, but also technical security risk. Camino's had over 18 audits. It's open sourced, smart contracts formally verified. So it's technical risk, market risk, but then having a really good team on it all the time means I can sleep a bit more than I used to.
Doctor?
The real answer, the only thing that wakes me up at 2:30 in the night is my dogs. But on 10/10, we had a big market crash, so I did get woken up. And the cool thing about the market crash on 10/10, for me, it was the first time in kind of memory that everything worked. So, the exchange worked, Prime worked, price feeds worked, margin calls worked. So I was up for all of kind of a few minutes. I noticed that things were crashing, and I actually went back to bed.
By the way, that was a Friday into a Saturday, so that's no small feat when markets are closed. So
That was the biggest clearing of risk that we've ever had in crypto.
Yeah,
In that
yeah.
24 hours, and that's really the first time this whole industry, your lending product, the customer experiences, everything. There are a couple things that didn't quite, a few delays here and there, but by and large, the ecosystem performed.
Yeah.
And that's super important. Don't lose that. Don't lose that fact. Don't forget about that when you think about what to do next after this discussion.
Patrick?
I thought that was a great answer. When the internet came about, tens of thousands of retailers became dozens of retailers. And it was a massive consolidation of retail globally. What keeps me up at night is the concept that the decentralized structure that Satoshi created and was built upon is going to lead to further consolidation, not distribution. And I think that you see people taking shortcuts in structure in order for them to allow to scale fast, that is going to lead to consolidation with greater bottlenecks, not less. Mm-hmm. And so that's what keeps me up at night, that we push for building ecosystems that have broad ability to disseminate. Because when you think about it, there's only 1.2 billion people on this planet that access the banking rails. There are 6.8 billion people that don't access the banking rails. And when you look at this, Visa's one, or MasterCard, excuse me, that was a giant error, is one of our big partners. Next year, 50% of all of their remittances are going to be cleared in MENA and Africa on using non-bank rails. 50% of all MasterCard remittances will be cleared using non-bank rails. And this is the future, and we need to continue to drive decentralization. That was a long answer.
No, it's great. I'm over time, as we can see, but then we have to end on a prediction. So December 31st, 2027, what's the size of the tokenized debt market? Oh yeah, we'll go around the horn. All right, let's go in reverse order. I keep picking Patrick.
6 trillion.
All right. What do we now? The size of tokenization right now is roughly $325 billion. So 6 trillion, that's a big number.
I'm going big, like really, really big. So a panelist yesterday said 10x. I'm going 100x. And the reason being is we're talking in 2 years, I'm going 100x. And it's because I think we're going to tokenize the largest markets first.
Mark?
I can't beat 100x, but I'm bullish. I mean, 10x even sounds a lot, but the trajectory that's going now, I'm going for 10 to 20x.
Oh yeah.
I'm going with 20x because
All right,
I think
big numbers.
big sizes are coming.
Thanks all. Really appreciate it. Thank you for being here.